Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. It is not intended, nor should it be considered an invitation or inducement to buy or sell any of the underlying instruments cited, including but not limited to crypto assets, financial instruments, or any instruments that reference any index provided by CF Benchmarks Limited. This recording is not intended to persuade or incite you to buy or sell a security or securities noted within. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making any investment decision. Some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. I'm Ken and Gabe, Head of Content, and I'm joined by Gabe Selby, our Lead Research Analyst. Hi guys, and thanks a lot for joining us for another episode of CFB Talks Digital Assets. I'm Ken, Head of Content, and I'm joined by my friend and colleague, as usual, Gabe Selby, who's over there in New York. Hi Gabe.
Hi, everybody. How's it going? Excited to, kick us off with the first part of the year, talking about what's happening in crypto for the next 12 months. So outlooks are always, you do your best to try and nail down some concrete examples of what you think should play out. But we all know things are pretty fluid, especially this market and this environment. So we have to just...
difficult to predict.
Yeah, but we can take small victories when we can.
Sure. What I want to start with, Gabe, is I'm looking at the CME/CF Bitcoin real-time index, the main institutional live streaming index for Bitcoin, and it's at 22,845 or around that level. And the last time we spoke, this context in a podcast was probably flailing around 19K. So this is a major improvement relative to that. And what's behind that, Gabe?
Yeah, we're getting close to that 23,000 threshold, and we've completely kind of come through the FTX wipeout that we saw in early November. And I think what you can take away is a few things. So one, it's not just concentrated in Ethereum and Bitcoin. It's more of a broader rally across digital assets, which to me means it's not as defensive as if you were to see just the bigger kind of mega cap two tokens, Ethereum and Bitcoin, doing a lot of the performance. You'd say this is kind of like a defensive bear market rally. This looks like it's a little bit more constructive than that. And so when we look at, the broader market, we can use our institutional measure, the CF Broadcap Index. And I'm looking at a few ways. So year to date, it's up, let's just say around 44% and change. And when you're comparing it to global equities, it's, outperforming by the biggest margin since January 2021. So it's a very strong start of the year. This does play into the outlook in, what we're looking for to happen when you're in this kind of environment that's still challenging. There's a lot of uncertainty. No one's really projecting, a pickup in global growth. If anything, most folks are calling for a mild to short recession, and that's what we're looking for as well. So in that challenging growth environment, I see crypto being set up to kind of poised to continue to kind of outperform other traditional risky assets. And we can go into those themes, which I summarize as kind of the 3 R's.
Before we jump into that, but yes, this is the, if you like, de facto 2023 Outlook podcast edition. So I'm looking at just drilling down or sort of focusing on the CF Broadcap Index a little bit more. Why do how do you actually account for this literally broad-based recovery across the board? We talked about Bitcoin. We did say it was a bit more widespread than that. But is there any sort of reason why we would expect several assets within the space, large cap, mid cap, probably a few small caps as well? I'm not so sure about the trends. Well, why would we see this broad-based, I don't want to say recovery, but certainly rebound?
I think if you look at really what was driving the market in 2022, it was a lot of the macro headwinds that we were dealing with, with inflation, tighter financial conditions, global central banks going, on a war to wage against these things and really kind of take a lot of steam out of the financial conditions. I think, the market seems to be kind of pricing in this pivot. So when we talk about the 3 R's, we're talking about relief of macro headwinds, we're talking about regulatory clarity, and we're talking about secular recovery. And with the first R, we're talking about relief. The market's really starting to price in maybe a quicker turnaround for leading central banks like the U.S. Fed to take, its foot off the pedal on increasing rates. And that has kind of had this, I think, kind of springboard effect, because when we look at the risk return profile of crypto assets specifically, you can typically see in these bull and bear market cycles, you rally very strong to the upside, and then you have these kind of bigger drawdowns. And we've approached that threshold at the end of 2022 after the fallout of FTX and the last deleveraging event, that we're getting towards that bottom threshold that you typically see, when a bear market cycle starts to kind of trough. It's maybe too soon to call the bottom yet, but I think the sheer asymmetry of the potential return, now that we've kind of gone through a major part of the drawdown, it's starting to draw investors back in quickly, and their market's always forward looking. So you anticipate this to kind of happen maybe before we get the definitive answer that inflation has fully peaked and we're on our way down, which is what we believe.
Sure. But I mean, and you alluded to this, Gabe, is it possible to know the extent to which we should discount this potential relief, recovery, or rebound due to the fact that we are dealing with the most volatile asset class in the world, or at least partly, we put it in, the broader macro picture? How much should we discount it on that basis?
Yeah, I think there's an old English expression, I think one swallow doesn't make a summer.
No, it's a spring. It's a spring, actually. One swallow doesn't make a spring.
Well, that's even better.
Yeah.
But, we're in crypto winter, so we're looking for a spring.
Yeah, exactly.
I mean, I'm starting to be more constructive. I thought, it would take maybe a little bit longer. And I'm going to keep an eye on a lot of these inflationary categories. First, ones that are stickier. And this is what we talked about in the outlook. So when you look at core services, this is something that continues to trend up. And what we've seen on the inflation side is mainly relief from the good side, especially like the cyclical goods such as energy.
So good, literally goods. Okay, right. Yeah.
Yeah, goods versus services. So when you start to see this market start to price in, a softer landing, a more bullish environment, one potential risk is that you start to see maybe some of these gremlins that were haunting us last year, like crude oil, which I think was trading closer to $90 this morning on West Texas Intermediate. When that starts to come up, it could probably give you a little bit of an inflation surprise to the upside, which would be very bad after you start to price some of this stuff in. You could get maybe more of a price correction down the road.
Sure. Just to be 100% clear, Gabe, I go back to this point, just to be 100% clear, when we're talking about recovery in terms of some quantitative recovery, we're talking about the PMIs, other indices of that nature that provide sentiment on particular consumption sectors. So, your services, your sort of like a hard goods or that kind of thing, and how these may be playing into a narrative of recovery in the outlook for inflation. Is that correct?
Yeah, exactly. You got it. So that's kind of what we're seeing here. Also, we can touch on just a little bit. We all know what happened in November with FTX and these, so-called Samcoins like FTT. Some of that news that you're getting.
Is that what they call them now?
Yeah, I think
God.
The FTT's gone up considerably. And I think you do have a little bit of that also micro kind of impact of what's going on with the bankruptcy proceedings. And if you get kind of more positive news with recovery, that tends to also have given us a tailwind in crypto overall. It's coming at kind of like all at the same time, where you got, I think the macro headwinds are shifting more to be constructive. And then we just get a little bit of a little constructive thing, with the shakeout of what happened last November. So we'll see, if the trend continues. You still need a lot more data, but I think, as far as when we tie it back to the outlook, we're off to a strong start.
Yeah, absolutely. I mean, we're starting to see some moderation, at the very least, in the language of the, not just the Fed, across the board for major central banks around the world. Would you agree with that?
Yeah, I mean, the ECB is going to probably be still a little bit more hawkish.
Yeah, I saw some of those comments today, which is, yeah.
I tend to focus on the Fed because it's been kind of the leader in this fight on inflation. A lot of people would argue it's the most important central bank to follow.
Can't argue with that.
If you want to extrapolate maybe what they're doing to other central banks, it seems to, they seem to foreshadow that pretty well. But, when we talk about the second R, right, regulation, we can link that back to what happened in November. And I know that you did a lot of work for the Outlook and covering the regulatory piece. I think it's fair to assume that there's a need for more clarity, to say the least, to get some more consumer protections and to get just some more, I think, definitive kind of frameworks that are more sophisticated.
The strong impression that I got was that although you're absolutely 100% right, it's just prima facie axiomatic. We do need a lot more clarity. We've needed a lot more clarity for a number of years.
Yeah.
But now more so than ever. Having said that, reviewing the sort of landscape as it stood, in a kind of aggregate form, really, really abbreviated form, the exercise that we did, although there was a few standouts. So, of course, in the US, you have the White House's framework for crypto assets. It's got a longer name than that, which will obviously spawn a lot of regulation and rules and discussion. In Europe, we had the MiCA, the Markets in Cryptocurrency Instruments, I believe, something like that. These are all things which are already on the table and due for further development. But, just to give an example, I mean, just now, literally today, we discovered that MiCA, the European framework, was going to be delayed. I don't know what that means. I don't know how you quantify that, but it's going to be delayed for a number of months, maybe a couple of months, to enable, for all sorts of reasons, to enable various service providers to catch up, people to get up to speed with the shape of the forthcoming regulation and so on and so forth. So, I mean, it's just, in a way, exemplary of the fact that we have a huge amount of fragmentation globally, certainly, and certainly in major economies in terms of the regulation that we have, the regulation that we need, and, probably critically, the pace of the regulatory development that we need as well. So, yeah, maybe that's probably the most difficult part to predict in terms of outlook.
Right. And so with this latest kind of, I think, delay that you're seeing in MiCA, do you think, I mean, it's tough to speculate, but it still seems like they have an opportunity to kind of still to lead other major regions on the regulatory side?
No, absolutely. I mean, it's better to have this really quite comprehensive framework. So we see both in Europe and in the US. That's got to be seen as a step forward, I think, compared to, as I said, the utter fragmentation, one department not knowing what the other department's doing, not knowing where you stand. So, yes, I mean, that is some progress to begin with. But, yeah, I mean, we are on a long road to clarity. I think that's pretty clear. That's probably the major takeaway at this stage in terms of regulation. But, Gabe, I just wanted to talk about maybe briefly or not so briefly, the final R, recovery. Now, how do you differentiate that from the first R, which is relief?
The relief is kind of the first step. And that's when we talk about the shift in the headwind from the macro and also on the monetary policy side, going to more of like a tailwind to kind of boost this thing. This is hopefully going to allow and foster, in my view, in our view, a more for these secular themes to kind of take hold. So some of these key themes that we're looking for would be, the DeFi space. This is, I think, a space that's piqued a lot of interest, especially given the recent fallout of FTX, which, was a centralized exchange. And a lot of DeFi enthusiasts really pointed to it as a case in point of, the code doesn't lie, and you can have these, DeFi protocols that are been kind of stress tested and weathered through some pretty significant storms. So it's a space that saw a lot of, I think, activity degradation in 2022. We saw TVL values plummet, but now we've stabilized and we've gotten to this point to where I think interest is starting to peak up again. So developer activity is going to pick up in 2023, and it's going to allow, I think, more of these protocols to kind of gain steam. And that's a space that, I think is going to help carry the recovery. I think another area would be, on the scaling side. So we've seen, a series of these tokens that are layer 2s that, use these popular level 1 settlement layers like Ethereum, and they've really boosted up the efficiency and the capacity for people to develop on the blockchain. So scaling is something that is getting a lot of corporate partnership attention. This is something that we outlined in our quarterly attribution reviews. And so for folks that, are just starting to listen in, we're talking about, actual blue chip companies. We have JP Morgan, we have, all these other Fortune 500 companies that are using public blockchains and these popular tokens to facilitate and execute transactions on real public blockchains. So I think that's a trend that's going to continue in 2023. And it's going to be very interesting to see what are some of your takes on what we're seeing with these secular themes.
Well, I mean, one thing that did come to mind and that we have discussed, in maybe the last week or so, within this kind of bucket, if you like, was the rebound of Solana. I mean, as we all know, Solana is unfortunately and inextricably linked to the debacles of the last several months.
So-called Samcoin, right?
Yeah, another so-called Samcoin. And anyway, I just want to kind of come back to a theme that, we touched on earlier. How much credence should we actually sort of put in the rebound of Solana, which in many ways would actually fit into your narrative, at least the beginning of your narrative, in terms of the interest. But of course, it is a little bit tainted given its recent history. And is this rebound rational, or is it sort of structural, or is it really just likely to turn out to be ephemeral and should actually not be given much credence at all?
Well, it might be too soon to say you're out of the woods and you're in the structural, kind of tailwind with Solana and you're in the clear. But certainly, it rallying, I think, close to about 100% or so. You can't ignore that.
Which in itself might be a bit of a warning signal in some respects.
Yeah, but it's, as far as a layer one settlement layer, layer one kind of programmable blockchain, it's still one of the top performing, fastest, with throughput and everything like that. It's garnered a lot of developer activity.
Technically, yes.
Yeah, technically. And so Ethereum, with its proof of stake upgrade, it's kind of unlocked this new wave of scaling partner layer two solutions that are coming into the space now. And it's going to be interesting to see the battle between, Solana, I would say, was once the top Ethereum killer, versus this new upgraded Ethereum, which is, going to be seeing its Shanghai upgrade, I think, here in March. And that's going to allow for, people to take out their staked Ethereum. It's going to, I think, allow for, further developments in the road. To answer your question, though, I think we're probably too soon to tell. I think Solana is overall here to stay. It's just, whether you kind of get that same kind of enthusiasm that it had before this fallout might be a little bit different going forward because of what you're referring to.
And just maybe towards the end of our discussion, we have sort of touched on institutional interest and the institutional interest and specific themes that are driving parts of the comeback, if you want to put it that way, or rebound. I noticed that in the Outlook, there was a chart labeled institutional interest diverges with price again. And of course, it was the our CME CF Bitcoin reference rate overlaid with CME Bitcoin open interest futures. And, you had the divergence of the price with the open interest. And in a way, you were sort of like drawing some conclusions about interest based on that, because clearly price underperforming in the sort of medium term compared with open interest. Is that correct, or am I missing a nuance here?
No, that's, I think, a good way to summarize it. When we look at the BRR, our flagship economic reality really of Bitcoin, we saw in our last market cycle an uptick in institutional interests if we were to proxy it using our CME futures total open interest. So the total number of contracts being created on the CME for Bitcoin futures. And we saw, a really strong uptick around early 2020 happening around COVID. And then we saw the Bitcoin BRR index kind of follow its way up. And we've obviously known what happened last year and the crypto winter that we're in, the collapse of crypto prices, including Bitcoin. But we've still seen kind of a resilient interest in these kind of more institutional type products, which would be our CME Bitcoin futures. This is telling me that despite the headwinds that you're seeing, now with prices, institutions are still trying to get more exposure into the space. And that's definitely one of the secular themes that we're going to see maybe in the recovery. So, we are privileged to experience this firsthand, being the leading institutional benchmark provider for crypto. And so I think we are comfortable, saying this is, it's been a strong, secular tailwind for us. It should be here to stay. So,
indeed, it's difficult to basically interpret it any other way apart from on the optimistic side, and indicative of continued institutional interest, which is what we're all about, right? So great. We've got some great themes from the outlook, the CF Benchmarks 2023 outlook, which you can find on our website and download from our LinkedIn, is available to read now. And it's been great to discuss it with you, Gabe, and look forward to having many more interesting discussions throughout 2023 about digital assets, because, despite what we saw in the last few months, it's still a really exciting market, and the best is yet to come, I think, right?
Yeah, I hope so. And as always, a pleasure. So until next time.
Yeah, thanks a lot, guys, and we'll speak to you again soon.